Hello and welcome again. This is Islam Ahmad. I will be your lecturer today. Please confirm if you can hear my voice and see my screen. You should now be seeing the risk warning written both in Arabic and English. I will leave this for a minute so you can read and review the risk warning before we start. The risk warning states that trading in Forex, CFDs, and other derivatives is highly speculative and carries a high level of risk. It's possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risk involved. The risk warning is also written in Arabic, so if we have any Arabic speaker, you can read it in Arabic. And also, this webinar will be recorded. You will have the opportunity to view it again, either in our website or our YouTube channel. At this time, you can have more time to read and review the risk warning. This is very important before we start or we speak about any trading. You should consider the risk involved and be aware of this risk warning. So our today topic will be about the Elliott wave. Please make sure that you can hear me clearly and also that you can see my screen. If you have any issue or you can't see my screen or you have any issue with the voice, please send me on the chat. Okay? Seems like everything is working fine. Let's move on. So before we go to the actual Elliott Wave Theory and how we can use it in our trading, we should take a moment to know more about the founder of the Elliott Wave Theory. This theory is named after Ralph Nelson Elliott. He was born in July 1871 and died on January 1948. He was an American accountant and author. He was inspired by the Dow theory, we will speak about this later, and by observation found throughout nature. So Elliott conducted that the movement of the stock market could be predicted by observing and identifying a repetitive pattern of waves. So Elliott was able to analyze markets in greater depth. So he was identifying the specific characteristic of wave pattern and making detailed market prediction based on these patterns. So Elliott based part his work on the Dow theory, which also defines price movement in terms of waves. If you remember, we had a webinar about the technical analysis. We spoke about the Dow theory. Just to give you a quick revision of it, the Dow theory states also that the market moves in wave, or he called it trend, and that history repeats itself, and the price action discounts everything. So this is the Dow theory was the starting point for Elliott to take this principle one step further and make his theory, which called named after his name, the Elliott Wave Theory. So he discovered the fractal nature of the market action. But to really understand the Elliott wave, you should always keep in mind that this is a step further in the Dow theory. So you always have to keep the Dow principles in your mind. So Elliott studied like 75 years worth of data. Okay, just to give you an example, this was in a time where no computer. It's not like now. It's very easy to get this data, but for him it was very, very hard. And actually, he was studying the data of stock market, not metals or currencies. He was studying the data of stock market. So he studied yearly and monthly and weekly, daily also. And back then there were no 1 hour or 30 minutes charts. It was only from daily and above, weekly, monthly, and so on. So he self-made 30 minutes and 1 hour charts across his research. So he was studying the stocks and also the indices. So his theory gained notoriety in 1935 when Elliott made an uncanny prediction of a stock market bottom and has become a staple for thousands of portfolio managers, traders, and also private investors. So why we study Elliott Wave until now, why he was so important, because he actually was able to predict. I want you to take a moment before we go on and think about this. Why we study everything we study? We are trying to make predictions. So if someone made any principle and with this theory or principle, he was able to predict the market move. So from this prediction, we can say that this theory actually simply work because it works in the actual market. We can predict the market action. So this is what happened in the 1935. Elliott was able to predict that we are now having a bottom, means in a stock market. Back then there was no short selling, you have to buy. So you either buy or you just hold and wait. So at this time, he said that this is the time to buy, and actually he was right, and the market rallied for a very long time. That's why Elliott is very important for us, and that's why we still almost like after 100 years of his prediction, we still study his work. So to give you some brief, the Elliott Wave Theory is a form of technical analysis that looks for recurrent long-term price pattern related to persistent changes in the investor sentiment and psychology. This is very important. We will go on in much details, but this is very important. You always don't use the Elliott Wave alone. You have to make this theory or principle align with the technical analysis tools. It should be also aligned with the Dow theory. And also the fundamental principle of all this technical analysis theories is that the market move actually come from psychology. So you always keep this in mind. You have to remind yourself every time that it's not just like numbers and lines, it's psychology. There is people trying to make money, greed and fear. That's why all these moves happen. And we try to predict the next move, but we always remind ourselves that this move is actually human being move. This is psychology. So this is the first thing you have to keep in mind. Second, you have to remind yourself that the theory identifies impulses wave that set up a pattern and corrective waves that oppose the larger trend. So Elliott believed, such as the Dow believed before him, that the market move in trend. So you can see the market moving, you think it's just random ups and downs, but actually there is a trend. So the uptrend is, according to Elliott, consists of impulses waves and corrective waves. We will come to this in a minute. So the third thing you have to be aware of, that each set of waves is nested within a larger set of waves that adhere to the same impulse or corrective pattern, which is described as fractal approach to investing. Okay, so what this means is that the wave that Elliott proposed, that financial price trend result from investor predonic psychology. So psychology is the cause of this wave. So he found that the swings in mass psychology always showed up in the same recurring fractal patterns or waves in financial markets. So as you can see, the wave in the C regarding to Elliott, the market move in the same way. So Elliott theory somewhat resembled the Dow theory in that both recognize the stock prices move in waves. They both, Dow and always say in his books and work, actually Dow didn't write a book, but in his articles, he mentioned that the market move in waves, and Elliott repeat the same principle, the price move in wave. So because Elliott additionally recognized the fractal nature of market, he was able to break down and analyze them in much greater detail. So Dow said the market move in wave, but Elliott is actually describing, as we will see, how this wave will shape, how we can predict and shape it, how we can paint it on the chart. So there is some structure which is an over smaller scale to infinity repeat themselves. So Elliott discovered the stock index price pattern were structured in the same way. He then began to look at how these repeating patterns could be used as predictive indicators of the future market moves. So if you were with me this time, now please focus with me, because now we are going to the actual Elliott wave and the actual market, the tool we can use. We were speaking about the waves, and now we will see it. What you can see now in your screen, this is the classic wave structure according to Elliott. So if you can see my screen, please, if you have any issue, if you can see my screen, write me on the chat if the voice has any issue. Okay, seems like everything is working fine. Out of everything I will say today, out of any slide, this is the most important slide. So please, if you are not focused, please focus with me in this slide. This is the most important thing that you will need, because based on this, you will understand everything else. Now, what you can see in the screen right now is the Elliott wave structure. It should be like 1 impulsive wave, then 2 corrective wave, 3 impulsive wave or a motive wave, then 4 corrective wave, 5 is an impulsive wave or a motive wave. Then we go to a corrective A, B, C. The correction here consists of 3 waves. We call them A, B, C. Simply put, the movement in the direction of the trend is unfolding in 5 waves. We call them the motive wave. While any correction against the trend is in 3 waves. We call them the corrective wave. So the movement is in the direction of the trend is labeled 1, 2, 3, and 5. And the 3 waves correction is labeled as A, B, and C. This pattern can be seen in long-term as well as short-term chart. So you can see the market moving in a 1-minute chart or in a 1-year chart. You will see the same market move, the motive phase and the corrective phase. Okay, so from this classic wave structure, you can use the Elliott wave in your trading, and we will now go to further details about this. But I want you to remember this structure, because this is the most important thing. So ideally, smaller pattern can be identified within the bigger pattern. In this sense, Elliott wave are like a piece of broccoli, you know, where the smaller piece, when you broke it, so the smaller piece, if broken off from the bigger piece, actually they look like the big piece. So this information about smaller pattern fitting into a bigger pattern, coupled with the Fibonacci relationship between the waves, offer the trader a level of anticipation, prediction when searching for or identifying the trading opportunities with the solid reward to risk ratio. So in the Elliott model, please, if you can see my screen, you should now be seeing the same words I'm saying. So in the Elliott model, market price move between the impulsive and the motive phase and corrective phase. So in the scale of the trend, the impulses always it will be in the set of 5 lower degree waves. So again, between this motive and the corrective waves. So the 1, 3, and 5 are impulses, and the wave 2 and 4 are smaller retraces of the wave 1 and 3. Okay, now please confirm if you can see the complete market cycle right now. I'm now having the slide of a complete market cycle. Can you see it? Yes. Please send me on the chat if you don't see it. Okay. I told you that the classic structure is the most important. Okay. This is really the most important. But now I'm giving you the real structure you will see in the market. Bear with me, please, and focus. If you can see my laser pointer, can you see it, please? If you can see it, okay. This is the Elliott wave actually in work. You will see what I'm showing you right now. We know that the Elliott wave move in 1, 2, 3, 4, 5, and then A, B, C. Okay, let's count with each other. This is 1, 2, 3, 4, 5. This is the trend, okay? And this is the correction after the 5 waves. It will be A, B, C. Can you see it? This is now a complete wave. It's finished. But actually, the 1, 2, 3, 4, 5, it's one in a bigger wave. This is the whole move. We count it as 1, okay? And then this correction, the ABC, we count it as 2 in this bigger wave. So now we will count 1, 2. This whole move, the whole wave is actually only 1, 2 in a bigger wave. So we continue, it will be 3, 4, 5. You see in this wave 3, actually it's consists of 1, 2, 3, 4, 5. And this 3 followed by 4, and the 4 is actually A, B, C for the 3. Then we have this move, which is 5, and then we go to the other direction of A, B, C. So now what you see, all of this was 1, 2 in a bigger move, in a bigger wave. You can now get the principle of the wave theory. It's not for the whole market only, it's only for the whole market and also the very, very little moves of the market. If it's a prediction of the whole market move. So if we continue, this whole move will be only 1, and this will be 2 in a bigger, 3, 4, 5 in the bigger move. So all this will be 1, 2, 3, 4, 5, and we will have A, B, C in the right side of the screen. And actually the A, B, C consists of waves also. So this one has 1, 2, 3, 4, 5 in it. So this is the shape of the Elliott wave in the real market. It moves in the sense of waves, smaller waves, then it continue to shape bigger waves, and you can move on from the 1-minute chart to even yearly chart, and you will see this motive waves and impulsive waves, corrective waves. This is the complete market cycle. You will see it over and over again, and even all this we have in the screen right now can be a 1, 2 in a bigger move. Now you get the point. This is the Elliott wave when you can see it in the market structure. So okay, we already discussed this. I don't need to repeat this again. You already got the idea right now. Okay, let's go back to the very small wave. There are 3 golden rules that govern the Elliott wave labeling. So what I told you right now, what I told you before, has 3 golden rules. This rules was set by Elliot himself. These rules cannot be broken. The first principle is wave 2 cannot retrace more than the beginning of wave 1. Now I just get you here a small wave so you can understand this. This is 1, 2, okay? When we're having the wave 2, this cannot exceed the wave 1 starting point. Wave 2 should be a retracement of wave 1, okay? So the retracement should only have like 99% of it. This is the maximum. If the wave 2 came to the starting point of wave 1, then we are not counting in the right direction. Then the counting is invalid according to Elliot. So remember, this is the first rule of the counting, that wave 2 cannot retrace more than the beginning of wave 1. these guidelines, these rules is very important because it will make you count in the right direction, because the most common issue with Elliott wave is count in a wrong way. Okay, so please focus on these rules. This is very important. The first one you remember is wave 2 cannot retrace more than the starting point of wave 1, and wave 3 cannot be the shortest wave of the 3 impulses wave. Here you have the shape of the 1, 2, 3, 4, 5 wave. Okay, this wave, the 3 wave, cannot be the shortest. Some studies or some predictions say it should be the longest. Actually, Elliot didn't state that it should be the longest, but he mentioned it cannot be the shortest. So if you have a wave starting from 1 and 1 or 5, is both of them longer than 3, you are not counting right. 3 cannot be the shortest wave. So we have 1 and 3 and 5. Out of this 1, 3, 5, 3 cannot be the shortest. It should be the longest, or at least the second one, but it can't be the shortest. So this is very important. And the third golden rule, wave 4 does not overlap with the price territory of wave 1. Here you can see my screen. Please, if you have any issue or you can see my screen, send me on the chat. Wave 1 here and wave 4 here. The wave 4 should not overlap with the territory of wave 1. If you can see this here, this area, wave 4 cannot exceed it. Okay? Here, the 3 principles, the golden rules. If you are going to keep only one thing out of this webinar, keep this slide. Okay, wave 2 cannot retrace more than the beginning of wave 1. Wave 3 cannot be the shortest wave of the 3 impulses, wave 1, 3, and 5. And wave 4 does not overlap with the price territory of wave 1. This is the golden rules of Elliot. Out of all his work, this is the most important, and actually this is the most principles that work when you count and get results in the actual markets, when you use these golden rules. There is additional guidelines. First is when wave 3 is the longest wave. So wave 5 typically approximate the length of wave 1. It's like it copies it. So if we have wave 3 is the longest, 80% of the time wave 5 will be as long as wave 1. This is a guideline. This is not a must, but it's a guideline. 80% of the time it happens. There is additional guideline when wave 2 and wave 2 and wave 4 must be different in as many ways as possible. For example, if wave 2 is a sharp correction, wave 4 is a flat correction. So the ABC correction end near the low of wave 4. This is the third guideline. You can see here the ABC move. It should end near the low of wave 4. This is also not a must, but a guideline. You can use it like 70% of time. Here I sum them again. When wave 3 is the longest, wave 5 typically approximate the length of wave 1. If wave 2 is sharp corrective, wave 4 is flat correction. ABC correction end near the low of wave 4. So the relationship between Fibonacci and the Elliott wave. If you were with me in the last webinar, I took the whole time to talk about the Fibonacci tools and Fibonacci sequence. If you were not, it's fine. I will review it very fast now. So the just to give you a quick hint, Leonardo Pisano or Leonardo Fibonacci, He was mostly known as Fibonacci. He's an Italian mathematician, was in the Middle Ages. He wrote his famous book, Liber Abaci, or in English, the Book of Calculation, in the year of 1202. The Fibonacci sequence is the most important thing we still use from this book of calculation. It's a series of whole number where each figure is the sum of the two before it. It starts with 0 and 1, which are known as the seed number. So the next number is 0 plus 1 equal 1, and so on. You add the number to each other, so you get the sequence of 0, 1, 1, 2, 3, 5. You can see, so 5 is the sum of 3 and 2, and 8 is the sum of 5 and 3, and so on. This is the, we called it the Fibonacci numbers. This is important because it gives us the Fibonacci ratios. So the Fibonacci ratios are a series of percentages calculated by dividing figures along the Fibonacci sequence. So there are quite a few different ratios, but the key ratios are 23.6 and 38.2 and 61.8 and 78.6, and of course the 161.8%. To see how they work, we will just take a quick look to review the 61.8%. How we get it? To find the 61.8 ratio, all you need to do is divide each number in the Fibonacci sequence by the one that follows it. So we do this along the chain. We will quickly spot that it comes out to roughly 0.618 each time. So from 21 divided by 34, the number will be 0.618. If we then convert the 0.618 into a percentage, we get the 61.8%. This is the most important ratio. And also, if you want to find the 161.8, you divide each number by the one that preceded. So you divide the 13 by 8, you get the 1.625, and so on. From the 55 divided by 34, you will get the 1.618, and to infinity. 89 by 55, 144 divided by 89, it will give you the same ratio. Sorry, so the 61.8 and 161.8 might be the most important Fibonacci ratio of them. We call them the golden ratio. They appear frequently across math, geometry, art, and so on, and even in nature you can find this. So Fibonacci ratio is useful to measure the target of wave move. We were reviewing in a very fast way. You can review the Fibonacci webinar. It's on our website. But we will use the Fibonacci ratio when we try to measure the wave relation. So different waves in Elliott wave structure relate to another with Fibonacci ratio, and we will see some example in the impulsive wave right now. So wave 2 is typically 50% to 61.8% of wave 1. Okay, meaning that we have 1, 2, the move of 1, 2. The wave 2 should retrace around from 50% to 61.8 of wave 1. When you see this, you will ask where we get these ratios. This is from the Fibonacci. So we combine the Fibonacci with the Elliott. And actually, you will never find someone using the Elliott wave alone. It should align with the Fibonacci retracement tool and the Fibonacci expansion tool, and also other technical tools. So wave 3 is typically 161.8% of wave 1, and wave 4 is typically the 14.6 or 23.6 or 38.2 of wave 3, and wave 5 is typically inverse, 1.23 or to 1.618% of wave 4. This is equal to wave 1 or 61.8% of wave 1 plus 3. So when you know this information, you determine the point of entry and profit and target to enter a trade. So to apply the Elliott Wave Theory, keep these points in your consideration. This is very important. You can print this slide, keep it always with you if you want to use the Elliott Wave. The golden rules are: wave 2 cannot retrace more than the beginning of wave 1. Wave 3 cannot be shortest wave of the 3 impulses wave 1, 3, and 5. Wave 4 does not overlap with the price territory of wave 1. And also there is additional guidelines. When wave 3 is the longest wave, 5 typically will be the length of wave 1. And if wave 2 is sharp correction, wave 4 is a flat correction. It should be wave 2 and 4, they should be different in as many ways as possible. An ABC correction end near the low of wave 4. So now, if you have any question, please feel free to send me. We already ran out of time, so I will quickly go to get some examples for you. And while this happens, please send me if you have any question. Okay, this is the euro-dollar 1 hour chart. If you can see here, if you can see my screen, please send me if you can see it. So the euro-dollar here is shaping the Elliott Wave complete move. This is the same chart, okay? This is the 1 hour chart with candlesticks, and this is the same chart with the line chart. You can use line chart. It will help you to draw the Elliott Wave. These lines, this is blue lines, I draw it. This is the way you draw the Elliott Wave in the chart. You draw it yourself. There is some indicators, but the Elliott Wave is very subjective. Actually, this is one of the criticism to the Elliott Wave. It's very subjective. So maybe two traders see the same chart and they both draw the Elliott Wave in a different way. So if it's working with you, then your drawing is correct. So this is just an example. This is a 1, 2, 3, 4, 5, A, B, C. This is now, this is the same chart. You can see this chart here. It's 1, 2, 3, 4, 5, and A, B, C. This is the euro-dollar chart, a live example of an Elliott Wave and how you can use it. If you, during the correction, you can go in the opposite direction of the market. For example, if you can see this is 5, so you can go short from here. If you are in the the end of the correction, you predict that the market will go on, and actually this is what happened. The euro-dollar move on very, very strong in the up direction. Here there is another example with the dollar-yen 1 hour chart. Here you can see this is now a downtrend. So the 1 is here, 1, 2, 3, 4, and 5. And then from here, we go to the A, B, C correction, and then the market continue the downtrend. So this was an example of the Elliott Wave applied in the actual market. So when you apply the Elliott Wave principle, try to use the guidelines and the rules we spoke about, because this is very important. Sometimes you can see here this is 2, it didn't exceed 1. 3 is not the shortest. Okay, you see we are applying this to the actual market now, and also the 5 ABC is complete. This is complete Elliott Wave in the actual market. So if there is any more question, okay, well, please We always have this webinars at the Thursday, 6 p.m. Dubai time. Please be with us in the upcoming webinar. You will receive an email after this webinar. You can also have a recording of this on our website and our YouTube channel. Feel free to communicate with us if you have any more questions. Please be with us in our upcoming webinar next Thursday, and very soon, if you are in Dubai, we will be having a seminar. I will give you more information very soon about this. Looking forward to be with you in the coming webinar at 6 p.m. If there is no more question, I will end this now. Okay, seems like everything is fine, so I will end this session now. Thank you and goodbye.